I've got three goals in these remarks. The first one is to make sure that all those who bet that Mike Clark couldn't speak for less than 50 minutes lose. So I'm going to try and keep my remarks to certainly less than 15 minutes. The second one is to meet Julia's objective. When we were discussing this, she said, for a general formula, I suggest you scare people. So I shall seek to do that. But also, if you're scared, you need to be encouraged. So I hope to encourage you by talking about a lot of things that are going on in the world I work in. Let's start with a question. Do you think financial markets are pricing the systemic risk of climate properly? I don't. And if you were wavering towards yes, let me give you an example. A UK pension fund published the following public wonderful statement. At 4 degrees, in 15 years, we expect to lose 60 or 70 basis points per annum. This would seem to ignore the fact that at 4 degrees, economic activity may be somewhat diminished. The insurance industry may have disappeared. So there's some interesting things out there which I'm going to touch on. How did we get to this? Many of you will be familiar with the NGFS, the Network for Green Financial Systems. I have problems with acronyms. I always have to remember to say what they stand for. They have done climate scenarios. TCFD, the Task Force for Climate-Related Financial Disclosures, said that scenarios were good. So NGFS came along and did scenarios. But if you give scenarios to economists, what do? They just model the things they can model. They don't model, we've heard about mass migration, they don't model Trump re-elected yes or no, they don't model all sorts of things that are hard to model. So the financial system has probably been greenwashed in many ways by those scenarios, and that's quite a problem. So it's come through very clearly in some of the work we're doing with pension funds. I have seen one or two fund manager exhibits which seem to suggest in a little graphic that this fund at 1.5 degrees looks a bit like this fund at 3 degrees. That could be interesting. I'm actually advising some lawyers on litigation in that area, which might interest people. So let's talk about the positive stuff. We've already had promoted, thank you very much, visual aid here, the Emperor's New Climate Scenarios, a fine paper by my profession together with two colleagues from the University of Exeter, which really highlights the problem of the standard scenarios. If you want to dig into why, I don't know how many of you do integrated assessment models and damage functions, but your research teams probably do. Loading the dice, a fine paper by Carbon Tracker. Flawed economic thinking on climate has put your pension at risk. And you delve into that and you see that the problem at the NGFS is that economists working in climate don't really do peer review. So if you show some of the things that are appearing in finance to climate scientists, they do not know whether to laugh or to cry. So that's identifying the problem. The next one, no time to lose. And Mark is in the room somewhere. He is the lead author on this. No time to lose is, he's over there, Mark, take a bow. No time to lose is a very brave attempt by USS, the university's superannuation scheme, to address the problem. They did lots of climate modelling. What happens is you do all this climate modelling, it gets to the trustee board, and they say, you've done a lot of good work, but how does it help us make a decision? And the sad thing, it doesn't. I was speaking to a banker the other day who was involved in the UK CBES, Climate Biennial Exploratory Scenarios. And I said, you've done a lot of good work. How's that changed the board's strategy at your bank? And he looked rather sheepish and said, it hasn't. Essentially, it's a compliance exercise. So back to USS, the University of Exeter. Standing back, asking the right questions, you begin to realize that you can't model some things, you need to do scenarios. So the USS work uses a frame of 4 scenarios. Mark is the expert on that. And basically, they are doing strategic asset allocation to begin with no numbers. Now, those of you who rather love modern portfolio theory, alpha, beta, all that good stuff, may be slightly surprised that anybody could be mad enough to do strategic asset allocation, which is actually preceded by strategic risk management with no numbers. But you know, the real world starts with not a lot of numbers. It starts with mass migration. It starts with how does the Ukraine war end? It starts with lots of things that are pretty unquantifiable, but if you put them into a scenario or scenarios, which is a very standard corporate planning practice, you could begin to make sensible decisions. So that's no time to lose. Very happy to talk about that if there's questions. The last one, just to draw to your attention, I'm sure Julia can put these on the website. There's a paper here entitled Net Zero Transition Planning for Pension Funds and Other Asset Owners. Now, that was actually sponsored and paid for. Thank you very much, DESNES, the Department for Energy Security Net Zero. And that is applying something called EAST thinking. EAST, E-E-I-S-T, is the economics of energy, innovation, and system transition. Forget the energy, just think of the economics of innovation and system transition. And this is a paper which is trying to help pension fund trustees think about their decision-making before they get to MPT, modern portfolio theory. It's rather flummoxed DWP, the Department of Work and Pensions, because how did DESNES produce something that's to do with pension funds? But that's another story. To highlight the problem, I was reading The Guardian this morning. I read The Guardian, the FT, seems to cover the bases. Here's a climate scientist. The first global temperature data is in for the full month of September. This month was, in my professional opinion as a climate scientist, absolutely gobsmackingly bananas. So that is where the climate science is and where I suggest finance is not. So that's part of the picture. What does that mean we can do? Well, I think one of the challenges in this room, it's a bit of a sort of alpha game. Climate risk is actually as much a beta game. So I think working out how you can help clients, help advisors at the strategic side, because frankly, we're not going to solve this, we're not going to meet this challenge purely making an alpha thing. There were comments about fiduciary duty. We may make progress, but I think I got involved with that with Freshfields of the PRI in about 2006. It may well be better if we start doing transition plans for everybody, including pension funds, and hold the owners of those transition plans to account. That may be actually more effective than trying to progress fiduciary duty, who's to say. We need to think about benchmarks. Do you really want your clients' assets invested using an index that's actually helping to destroy a world that your clients live in? So when you begin to think deeply, benchmarks, indices, there's a lot of things that we need to rethink. I was a non-exec at Brunel, LGPS, for nearly 4 years. Our little tagline was investing for a world worth living in. So I think this investing for a world worth living in is a helpful sort of motif. So I think, so we can leave time for a question or two, I'm going to wind up. And any of you who bet against the 50 minutes have just lost, because the Q&A doesn't count. And we'll see where we go with the Q&A.
Brilliant. Is this mic on? Thank you. So there must be some questions from that. I've always got questions for Mike, but I'm not going to kick off. So please, can we have got the mics around? And the light's not working, reflecting off my glasses. But the essence of what Mike is saying here is that all these people, whether you're governments, financial services, or whoever, are looking at a load of numbers that actually don't make sense. They're not right. They might be trying their very best to make the right decisions, but it's based on dodgy data, because the world isn't about data. The world's about real stuff, right? So I totally support all the work that Mike's been doing and other people who are working in this area. But can I ask for questions now? I didn't see a show of hands.
I'm just going to add to that. Saying the data is not enough is a displacement activity. Investors have always made decisions with adequate data. So moaning about the data gets a red card very quickly.
Sorry. Okay, red card to me then. There we go. Yeah, okay, so be aware and ask questions and look under the bonnet and all that stuff. And read the reports because as I said earlier, I did a brief piece for Money Facts on it, trying to condense it down into kind of less complicated terminology, etc. And obviously I had to go to Mike for help with that anyway to get it checked. But it's complicated stuff, and so much of the stuff we've been told for years just doesn't stack up. And I think a lot of us in this industry just had this gut feeling that it didn't make sense. And now we've got the evidence.
I think that unlearning is a really important point.
It's going to be hard. Lots of senior
You've
people.
got to unlearn some of the things that you thought were true.
Yeah.
Price doesn't always work. If systemic climate risk is ignored, it won't be priced. So price doesn't work, and that's the problem. I think there's a question here.
So to your point about unlearning, if you were with your crystal ball, which are the sectors within the benchmark? Obviously, I would imagine oil and gas and coal would probably be one, but no sector is clean per se, particularly if you include biodiversity. Which are in your sights to ignore and carve out?
Well, the way we're tackling that with USS, because they, bless them, actually published that before phase 2 of this project has been completed or even almost started. Think about it this way: lean into good beta and lean away from bad beta, and own those decisions in the entity that's making the decision. I'll give you a good example. I carry no candle for Cushion, the DC Master Trust. I think we had a bit about DC earlier. Cushion decided some while ago that the official scenarios were totally useless. And what they did was they said there's not a lot of money in DC for active management. So we are going to convert the fiduciary's views into an index, and they use Selective for what it's worth, and then we'll give that index to a manager to invest passively. Now, I can tell you in that one, there ain't a lot of oil and gas. So at some point, it is quite possible to believe that, oil and gas may have a Kodak moment. If you look at, you really sort of can dig into things. If you look at the tipping points, then there are tipping points approaching. And one of the things you might want to think about is, if a Minsky climate cascade, a sort of cascade of risks, integrating climate risks with other risks which crystallize and compound, you sort of have to make that decision where you are, and that decision is owned by the investment manager, by the pension fund trustees, possibly by the advisor. So you just begin to think, and you have to sort of put benchmarks and indices to one side, because you're really saying, I think, where do citizens of the world want their money invested? Well, we need to reduce emissions by probably 8% per annum to 2030 to have any chance of a good outcome. So, how do I want to finance less emissions? You get to oil and gas, some of the energy stuff pretty quickly, but once you're doing stock selection within sectors, think about the strategies. Some of you may be familiar with the Transition Pathway Initiative, which assesses companies' skill, competence at this. One of the things I throw at pension fund trustees, I don't know if it works in the IFOA world, is, so please tell me how the insurance companies in my portfolio, sorry, that was my timer, which I clearly...
That's another question.
That was my timer, which I just set. How are the two insurance companies in my portfolio coping with the possibility of the subpolar gyre tipping? Now, there's probably not many people in this room that are familiar with the subpolar gyre. I'm certainly not. No questions, please. But there are a range of tipping points out there which we, the world, finance, are edging towards. And they're going to happen. So how do we reduce the effect or avoid them and begin to think of avoiding a sort of risk cascade is how I'd frame the problem at your end. Okay?
George, question over here, and then to Mark, please.
I'll volunteer that I lost my bet, Mike, on your timing. But I just want to pick up on the point you made at the end of your comments about benchmarks and just what your suggestions are for how we replace them. You know, we've talked about benchmarks many times before, but we seem to be hardwired to want to be able to communicate a very simple comparison, and it's not just, you know, in investment terms where we're sort of trapped by benchmarks. You know, chief executives are measured against earnings per share targets that get abused. Governments are measured against GDP figures that aren't always the right benchmark to measure against as well. So how do we get away from that sort of seemingly innate desire to have a single number that we can boil everything down to?
It is really hard, and I've been in many conversations, George, of that. The first thing is to realise that it is not your goal. I remember there's a famous occasion, it was actually at the Paris COP, when a young lady from MSCI said, these new climate-aware benchmarks are jolly good, but their tracking error is terrible. Well, that sort of gets the point that actually that was your target, the low-carbon benchmark, and the other thing had a tracking error relative to it, the other way around. So it's so hardwired, but we need to begin to, I think, firstly accept a greater tracking error relative to it, because my suggestion is that standard index, which may be a benchmark, is actually not what you're trying to invest in. You are not trying to invest in, and because it's hardwired, and because the whole sort of investment infrastructure around that of tracking error and all that stuff, when I was getting others to review that last fourth paper, the East paper, one of the reviewers said, Mike, how old was the late Queen Elizabeth when Markowitz was doing his stuff, and how has finance theory changed since then? And that sort of brings home your hardwired point. But we have to realize they are mental barriers, and what we do is actually part of the ongoing conversation. So it's not a precise answer, but realizing that they are a problem, and you know, you don't have to track them because they're not really what you're trying to do, is the first realization of truth, I think.
For sure, brilliant. And the planet doesn't care, and people who are suffering as a result of climate change in countries that are being flooded don't care two hoots about whatever benchmark some advisor or whoever's using here. I'm going to come to Mark very quickly, and then I'm just going to do my last 3 minutes. Can I ask you, let's do Mark first, please.
Yeah, well done, Mike. Bravo for your show. I just wanted to make an observation which sort of ties up some of the other questions, actually, which is to get across the idea that we need to get away from the obsession with risk, particularly quantifiable risk. Sorry, Julia. But you have a role as well. I'll get to that. But the point is that we are living in a world of radical uncertainty. What's radical about it is unquantifiable. It's unprecedented. There isn't data because it's unprecedented, folks, right? So what are we going to do? Well, we have to go through the scenarios and look for common threads, things that are resilient. So another R word, we go from risk and return to resilience and uncertainty, right? So what is a resilient strategy? Well, we know from our 4 scenarios, if you think they are credible, there's only one scenario where we actually get anywhere near net zero. So the other 3 are various degrees of failure. What does failure look like? Well, it's a world where we need a hell of a lot of adaptation. Let's have a look at stocks and bonds that benefit from adaptation, because that's not being properly priced either. So you need to be looking for things that are robust in different states of the world. This is a directional thing, it's not a quantifying thing. So the other thing you need to be looking for is, in quite a few of these scenarios, cutting-edge green technologies are dangerous, they are risky. What you need to be looking at is green technologies that are already proven, that are on their S-curves of adoption. So you look for those kind of things as well. So it is a major mindset shift that people, I think, need to go through once you truly adopt a proper approach to climate scenarios.
Yes to all that. I'm just going to build on one very short comment. Another possibly new phrase for you is derailment risk. Derailment risk does what it says on the tin. It has come out of work which realizes that we need to both mitigate and adapt. And if humanity, including finance, does not devote enough resources to mitigation, which means there'll be less adaptation, we will have a fundamental problem, which we can call derailment risk, that we are not devoting enough resources to the problem. I find it a very helpful concept to apply to any organization. You know, if you are not devoting enough resource to all this, derailment risk is actually an organizational concept.
Thank you. Whoops, put the mic down, so thank you. That's brilliant, and I could, yes, go on to when the penny dropped for me on all of this, which was actually about 25 years ago. There's just so much stuff where you just go, this is all going to go horribly wrong if we don't do something. The implications are immense. Did you want to say a final couple of words, or are we good?
No, I'd just like to say thank you very much for being here.
Yeah. Yes, can I ask you to thank Mike?